All right, so now that we've talked about the different types of returns, now we're going to go into understanding return on and return of. So my disclaimer, of course, I'm not a CPA, I'm not an attorney, I'm just a guy that's done this a lot. This is all based on my experience. Please consult your own professionals before attempting anything we talk about. So the objectives for the class is to explain the different ways your deal sponsor can structure the distributions and the effect it can have on your return. Did you know the way the deal is structured may affect your tax situation? Always consult with your accountant or your financial advisor for your specific case. Now, the two different things we're going to talk about today are return of and return on distributions, and we're going to go into detail as to what they mean and how they can affect what you're trying to do. So the first thing to understand is that every time you invest in one of these deals, you are going to have a capital account basically created. Your sponsor may or may not put that in your own name on the balance sheet, but it doesn't matter. In the background, right, there's always going to be an account that kind of stores your capital. Okay, so that's what we're going to be talking about as we go through this. We're going to be referring to this a lot. So the return of example. In a return of situation, every distribution that's sent out is considered a return of your investment capital, right? It's not a return on the capital, it's a return of that capital. So with every distribution you receive, your capital account will be decreased by the amount of that distribution. An example of this, investors contribute $1 million to the deal, so their capital accounts are $1 million. Over a 5-year period, the investors receive $100,000 per year, which is 10%, in distributions. So at the end of that 5th year, they've received $500,000 in total, and their capital accounts have been paid down to $500,000. Because remember, this is a return of your capital example. So that $500,000 you've received over that 5-year period has paid down your capital account because it's a return of. Okay, next, we're going to talk about the return on. So when the sponsor structures it as a return on, you will start with the same $1 million in your capital account, but the account will reflect, well, that reflects their initial investment. Stop, I want to start over. Okay. All right, so now return on. When the sponsor structures it as a return on, you will start out with the same $1 million in your investor's capital account, and that reflects the initial investment. This time, however, the distributions are not returning their capital. These distributions are instead providing a return on that capital. Because of this, distributions do not decrease the investor's capital account value. So again, you have a return of, you have a return on. The return of means you're getting your investment back. The return on means your investment stays where it is, but you make money on that investment. Okay, so the return on example, the same thing. The investors contribute the same $1 million and have the same $1 million capital account value. After year 5 of receiving the same distributions, the $500,000, their capital account is still the same as the day they initially invested, or $1 million, because the distributions were a return on their investment. So let's put it all together. We'll have some graphics here to make it a little easier maybe. So let's talk about the deal first. So this example deal, the purchase price is $4 million. You take out a loan, 80%, which is 3.2. Your down payment for this property now is $800,000. Your closing costs, operating capital, and rehab, $200,000. So the total needed for closing is $1 million, the $1 million we've been talking about. All right, so the next step in putting it all together is the movement of the cash throughout the life cycle of this project. We're broken down into a return on and a return of column, basically. So the first thing you're going to look at is the total invested capital. Same thing, $1 million in each example. Now, next line down is limited cash flow distributions. So the investors got $500,000 over that 5-year hold period in both situations. Next, resulting capital account balance. Because the first column is return on, that $500,000 does not draw down their capital account. It's still $1 million. Return of, the $500,000 is returning the investor's capital to them. So now your remaining capital account balance is $500,000. Your sale proceeds, after you pay off the loan and some fees and commissions, you're going to walk the project basically is going to walk with a $2 million return profit. From that $2 million profit, in the return on example, you have to pay off the capital accounts, which is $1 million. Return of the capital account was only $500,000, so you have to pay those two off. Return on, after you paid out those capital accounts, you have $1 million left to distribute. The return of, you only had to pay off $500,000 to make them whole, so now you have $1.5 million left to distribute. The distribution in this example would be an 80-20 split, meaning the deal sponsor or the syndicator would receive 20% of the leftover profit, and the limited partner or the passive investor would receive the balance of 80%. So the GP or the syndicator would receive $200,000 in a return on example. They would receive $300,000 in the return of example. But what you care about is the passive is the next line, obviously. So the LP, limited partner, or the passive investor will receive $800,000 in the return on. In the return of, you would receive $1.2 million. So there's a difference in the way this is structured because of the return on, return of. You see how it plays itself out in the LP share of sale proceeds. Now, a comparison of the two returns. Remember, we're going to have cash flow distributions for both the return on and return of. They were both $500,000. The return of the capital accounts was different because return of paid it down. Return on did not pay it down. So your capital account balance when they sold was $1 million for the return on, $500,000 for the return of. Then finally, the distribution of sale proceeds on the return on, you got $800,000. Return of, you got 1.2. Add it all up, the return on gave you $2.3 million when you sold the property, and added to that the cash flow distributions and the paying back of the capital accounts. Return of doing the same thing, you come up with $2.2 million. So as you see, there's not a huge difference, but the total return percentage for the return on example is 230% or 23% average per year. The return of is 220% or 22% per year. The red at the bottom of the screen is kind of important here. The 230% and 220% returns include the original investment, so the profit is actually only 130% or 120%, more than doubling the original investment. So that's important to remember, right? So understanding the return on and return of key takeaways. The difference in the investor's return between the return of and return on is not always going to be that large, but sometimes it can be. The main thing to understand is the difference, how the sponsor is structuring the deal and what the end result is projected to be for the investor. And the bottom line here should be whether or not the projected return for you as the limited partner or passive investor, regardless of the way they characterize the returns, fits within your investing expectations and model. So, big picture here, what are they projecting to return to you over annually and then at the end with everything rolled in? Does that fit what you're looking to gain on your investment? If it is, you're fine. This is important because you just have to know what's going on behind the scenes. You need to know what is meant by all these different terms you're going to read in the operating agreement, the subscription agreement, the PPM. So that's the basics of return on and return of. Thanks for watching this one, and we'll catch you on the next one, and we'll dig some more into some of these different terms. Thank you, guys.